Let me stop there and see if there are any questions on the outlook or our activity on the private market side. If not, I will move on. Please interrupt if you have questions. So on page 6, we have our typical asset allocation compliance slide. This is looking at the portfolio through the lens of the 4 primary asset segments: growth, more equity sensitive areas of the portfolio; fixed income, which includes both core as well as more credit sensitive assets; our inflation sensitive assets, the real assets, which act as a hedge against unanticipated inflation; and then our diversifying alternatives, which, as the name implies, are meant to improve the expected risk-adjusted returns of the total portfolio by being less correlated to the other 3 risks. You can see that the portfolio sits very close to their target asset allocations. There are no outsized asset allocation tilts within the portfolio, and that's pretty typical. We look to run the portfolio fairly true to their targets, and our tilts tend to be, as I pointed out earlier, intra asset class as opposed to between asset classes. And then one of the last slides that I'll cover here is, in fact, performance. You can see for the quarter, the portfolio was up 2.1%, a bit behind its policy index, which was up 2.5%. I contrast that with exceptionally strong performance over the 1-year period, with the portfolio up close to 27% compared to the policy index, which was up 25.8%. And over the longer term time periods out through 10 years, you can see that the portfolio has outpaced its policy index, which leads me to with a comment I wanted to make about indexing within the portfolio. So the policy index is meant to align with the board's approved asset allocation. It is a relatively granular index that includes U.S. equities, non-U.S. equity, low volatility equity, core fixed income, credit sensitive fixed income, commodities, REITs, the whole host of asset classes that make up the approved strategic asset allocation. And that's meant to capture, I'll call it implementation value add, or manager selection. So how well do managers do versus their benchmarks, as well as those intra-asset class tilts, value versus growth, emerging markets versus developed markets, etc. Now, it's important to keep that in mind because there are the asset allocation itself offers value relative to, I'll call it an undiversified portfolio. So something that is perhaps strictly stock bond, whether that's a 60-40 portfolio or 70-30 portfolio, or you might do a little bit more diversified, which would be stocks, bonds, and perhaps publicly traded real estate as an example. And the reason I bring that up is as we look at the underlying segment performance, and I'll flip us forward to page 10 here. One of the things which was very beneficial to the portfolio's performance within fixed income was a lower level of interest rate sensitivity or duration. You can see over the last year, the total fixed income portfolio was up 11.2%, and it did underperform relative to its policy index, which is that more granular aligned index. But the makeup of that fixed income portfolio was incredibly beneficial relative to a core duration sensitive portfolio, which is measured typically by the U.S. aggregate. And that the Bloomberg Barclays aggregate index was actually down about 20 basis points over the last year, is down about 2.5% on a year-to-date basis as interest rates have increased. And so I'd contrast that with your fixed income portfolio, which was up 11.2%. So having less duration sensitivity, more credit orientation, and exposure to more floating rate obligations was very, very beneficial for the portfolio. So I wanted to make that point here. And then finally, as you look at these numbers here, one of the things which jumps out, I think, was total real assets, which were up 5.5%, but were the worst performing segment of the portfolio, as both growth, fixed income, and diversifying alternatives all handily outpaced that. A lot of that 1-year performance was really driven by the first half of 2020, as inflation expectations really collapsed. We have recovered some of that performance, but not nearly all of it. And so you see the laggard in terms of real asset performance relative to other segments of the capital markets. So let me stop there, and I'm happy to answer any questions from the board as they come up.
Any questions for Tom?
This is Commissioner Stan. Question for Tom.
Please.
Yes, Commissioner.
Yeah, can you hear me? Okay, great. On that total real assets line, I must correct me if I'm wrong. I think that's including real estate and, of course, commercial real estate. The pressures for that to go up in value, I think, are going to be lower because companies are finding alternative ways and probably going to retain those alternative ways for people to work. So I'd say the commercial market's going to be depressed for a while. So is that a state of play in kind of what our share ratio portfolio would have within total real assets? Any questions, any comments on that?
Commissioner, absolutely, and good question, and certainly one that is top of mind. So to answer your first question, yes, total real assets does include private real estate as a component of the total portfolio. And I agree with your comment about the pressures that commercial real estate is likely to come under, but a couple of offsetting features. So while I would agree that office space in particular and retail, which have been under pressure, and it's gotten, I would say, exacerbated through the pandemic, they are offset somewhat by the increase in industrial properties, for example, which have seen reasonably sharp increases in value. So there's a little bit of offset there. And I think portfolio positioning therefore becomes very important. So the long-term goal is for us to diversify the real asset portfolio away from private real estate. But private real estate, because it's such a large asset class, and we do think there are idiosyncratic opportunities within it, does remain a reasonably good-sized portion of that portfolio. But we think you're going to be better off focusing on more value add opportunities or repositionings as opposed to core income generating only real estate positions, because I think those are the ones that are most susceptible to those pressures that you alluded to.
Okay, thank you.
Of course.
Tom, question for you about the big picture allocation. So as you know, the big picture allocation between growth, fixed income, real, and diversifying assets is set by the board. Obviously, your portfolio strategy team has their own opinions about that. Could you comment on how our high-level allocation looks compared to what your portfolio strategy team would recommend, or what other pensions with similar risk profiles are doing?
Absolutely. Let me think. High level. So in terms of what you've approved versus what our portfolio strategy team would recommend, I think those align pretty closely. And the reason I say that is the asset allocation modeling and optimizations that we do that are presented to the board are built based off of our strategy team's forward-looking asset expectations. So those underlying models, which we spend a lot of time working through and verifying and validating. So because those building blocks come from the portfolio strategy group and our investment research team, those are translated into proposed portfolios, which are then approved by the board. So I think there's very strong alignment between the I'll call it a recommended portfolio from our strategy team versus what is approved. And in fact, I think that the El Paso portfolio relative to the broader universe of public pension plans does differ in that it has less duration sensitivity versus those other plans, which we actually are in favor of, given our expectation that rates are likely to increase, and we actually would look to build specific diversifiers into the portfolio, which might have traditionally been that role would have been played by core fixed income. We think the diversifying assets through marketable alternatives or risk parity within the El Paso portfolio could be a bit more resilient in the current environment, given our expectations for rising rates. So El Paso, relative to our portfolio strategy, relatively closely aligned. We like that. El Paso's higher level portfolio positioning relative to the broader universe of pension systems probably has less duration sensitivity, more explicit diversifiers outside of fixed income built into it. It's probably does have a little bit higher real asset exposure than the broader pension universe. And I can put some numbers on that. I would say real assets for the universe of pensions would range somewhere between, call it about 11 and 15% or so. So the El Paso portfolio does have a bit more inflation protection built into it than than the broader pension universe.
Great. Thanks very much, Tom.
Of course. Any other questions from the group? If not, I'll turn it back over to the board chair. Thank you very much.
Thanks, Tom. Appreciate that update and overview. All right. So, well, Tom has stopped sharing the screen there.
There we go.
Next item is Executive Director's Report from Greg, and I think Greg is going to have a screen for us as well.
Whoops, wrong one. Hold on. Let me get the right one up. Sorry, having a little technical problem getting the right presentation to load. Give me a second.
No problem.
There we are. So this will be mercifully short. Good morning, everyone. Because we do have a number of items to talk about in session, so this will be rather quick. So we like to start with our big picture overview. If you look at our liabilities versus our assets, we continue to tick in the right direction. So at year end, we had an unfunded liability estimate of $238 million, resulting in a funded ratio of 64%. As of our most recent month-end reporting, which is March month-end, that unfunded liability is down a little bit to 219, getting a funded ratio just ticking slightly higher to 67%. So that's obviously news in the right direction. Now, that actuarial liability, the last update we have is from 2020 year end. We are about to get our the final, so that's just an estimate. That could change when we get our final. Our AVR and GASB reports are complete. We're reviewing those now. Those are going to be presented to the board at the next meeting. And our year-end audit, which of course is driven by those to some degree, is now being completed because those reports are done. Both of those will be discussed at the next meeting, so those are well in hand. And you may remember we used to get these in June and July from previous vendors, so much more county friendly in terms of timing. So I'm glad about that improvement. Apart from some of the topics we'll discuss in session, I remind the board that the master plan document, the actual governing document for the plan, which was originally drafted in 1967, we have done a very extensive review of that, looking for inconsistencies and incongruities as well as ambiguities, problems in the plan document that basically expose us to possible complaints or even lawsuits by our members. So we're looking to close that down. And that's a very extensive review that we'll do at a time of the board's choosing. So our work is largely done, and we stand ready to push that out to you guys when you're ready. And then we have a couple of exec sessions today, and for that, whenever Chris is ready to go into that, I will send an invite which will invite you to that session. So you want to leave this public meeting and accept and join that session, and then we'll of course come back once we're done in this new virtual world. Unless anybody has any questions about what's going on with the plan or with any of the work we're doing right now.
Any questions for Greg? Right. Thank you very much. All right. So the next item we have is the resolution to approve plan design changes, item 5 on your agenda. So hopefully everyone had a chance to review that. What I'd like to do today is table the vote on this to next meeting. And the reason is we have 3 voting members today out of 5. Next month, we're expected to have all 5, including a new board member that should be appointed, confirmed on May 4th, excuse me. So because of that, and we've got a couple other stakeholders that we've yet to meet with, what I'd like to do is table the vote on that to next month, but open it up for any discussion if you've had an opportunity to review that resolution. So there shouldn't have been any surprises on that. Does anyone have any questions regarding that, or are we okay just tabling this vote at this time?
I just have one question, Chris. Who are the stakeholders that we still need to meet with on this?
Largely the county commissioner and that are not part of the liaison group, and I believe county administrator. And I would, yeah, the current county administrator.
Chris, just one question, just on getting that done before the next meeting. Who's gonna carry the football on that one? Is that a chairman of the board thing? Is that exec director? Is that a Nikki Simmons thing?
Yeah, I'm gonna coordinate those meetings and make sure that we're all on the same page as we move this ball forward.
Okay, thanks.
All right. If we're okay with all of that, let's go ahead and move to the next item, which is actually 3 items. We've got executive session on 3 items listed on the agenda. And I'm going to go ahead and make the motion that we go into executive session. And I'm going to read the 3 items here, purposes for those executive sessions. So the first item, agenda item 6, for purposes of receiving legal advice relating to the failure of a vendor to deliver on a multi-year contract as authorized by CRS 24-6-4024B. Agenda item 7 for executive session is regarding meeting with our attorney for purposes of receiving legal advice relating to the release of personnel information as authorized by CRS 24-6-4024B. And the last item for executive session discussion, agenda item 8, determining positions relative to contracts with pension management vendors that may be subject to negotiations, developing strategy for negotiators as authorized by CRS 24-6-4024C. So that's the motion to go into executive session. Can we get a second?
I'll second it.
Okay, all in favor?
Aye.
Aye. Okay. And I'll just, Mark was on mute, so I'll let the record reflect that he did say, raise his arm.
Yeah, that was an aye.
Great. All right, so we will go ahead and drop off of this and we'll jump into executive session. For those who are not in executive session, if you want to wait for us to come back, feel free to do that. It might be a little bit, as we've got a lot to discuss there. I'll see you all over in the executive session, and you should have a new invite from Greg to join that. Chris Long
is now exiting.